We have another one of those weeks coming up, where central banks will stand centre stage. And this time it's the Bank of England that will be calling the shots, or at least it'll be trying to, as it scrambles to get back on top of inflation and regain the initiative, having made a bit of a mess of it with its story that inflation's early surges would prove to be transitory. The old lady of Threadneedle Street pushed through her first interest rate increase in summer 2018 last December, and after a sequence of 6 hikes in total, the base rate's now reached 1.75% compared to its starting point and historic low of 0.1%. As I sit here right now, markets are pricing in a 24% chance of a half-point increase and a 76% chance of a 3/4 point rise to 2.25% or 2.5% respectively, and the chances on a 3/4 point increase have shot up over the past week. Besides the headline interest rate decision, economists and investors will watch for 3 more things. First, how the Monetary Policy Committee, or MPC, voted. It was 8-1 in favour of a half-point rise at the last meeting in early August, and the dissenter favoured just a 1/4 point increase. Second, they'll look for comments on quantitative tightening, or QT. The Asset Purchase Facility, or APF, peaked at £895 billion of gilts and corporate bonds, but that's fallen very slightly to £863 billion as bonds have matured and the money's not been reinvested. The MPC hinted at a plan to start actively selling the bonds in September, with the result that the combination of liquidation and maturity would reduce quantitative easing by some £80 billion over the next 12 months. Finally, they'll look for any indication on what the Bank of England may be doing going forwards, especially as the US Federal Reserve seems set on keeping monetary policy tighter for longer than markets had begun to expect, at least if Chair Jay Powell's speech at Jackson Hole, Wyoming is anything like a reliable guide. For the moment, markets expect the Bank of England base rate to go from 2.5% to 3% in November, to 3.5% in December, and then peak at 4.25% next spring. The first rate cut is currently expected in December 2023. Now, there's a long list of scheduled results releases and trading statements lined up for the coming week, although not one of them is from the FTSE 100. Mid-caps and small caps will dominate, and names which may be worthy of further research include the following, although again, some of these dates could yet be subject to change. So we've got Abcam on Monday the 12th of September, Fever Tree Drinks, Churchill China and Harworth on the 13th, Dunelm, Redrow, Portmeirion, Tullow Oil and Neox, the company formerly known as Circassia, on Wednesday the 14th, MJ Gleeson, Hilton Food, Kia and DFS Furniture on the 15th, and Superdry and Keystone Law on Friday the 16th of September. But the company which just could cause the biggest fuss in the week ahead may be Renishaw. The precision instrument specialist is due to release its full year results to the end of June on Thursday the 15th of September. Now, although Renishaw is based in Gloucestershire, only a very small percentage of its revenues actually are generated from customers in the UK, and last year nearly half of group sales went to Asia and more than a fifth to the Americas, with the rest going to Europe, the Middle East and Africa. The FTSE 250 member also has a very wide spread of client industries, ranging from automotive to aerospace, consumer electronics to healthcare, and power generation to construction, so Renishaw has a pretty good insight into what's going on globally. It should therefore always be worth listening to whatever this company says, and it actually doesn't say it very often if you look at its regulatory news releases for 2022. In this context, it's interesting to see the shares trading at a 12-month low after a fall of a third over the past year, and the shares are actually down by almost half from their spring 2021 peak. Now, actually, May's trading update read pretty well, as Chief Executive Will Lee revealed a 21% jump in sales and a 47% advance in adjusted pre-tax profit. Stated pre-tax income was up by 13%. Mr. Lee also gave some guidance for the full year, and these will be the starting points when analysts and shareholders assess the results. Mr. Lee suggested that sales would come in between £655 and £675 million, a year-on-year gain of 18% at the midpoint. Note, by the way, that the consensus forecast for fiscal 2023 is looking for a further 5% increase in sales to just over £700 million. So we can use that as a benchmark if Mr. Lee gives any guidance. He also said that adjusted pre-tax profit would reach between 155 and 170 million, a 17% year-on-year increase at the midpoint. For next year, analysts have penciled in a slight drop to 162 million, and I guess that reflects worries over a global economic slowdown. And this is one of the reasons why Renishaw is so interesting. Since 1995, the company suffered just 9 drops in earnings on a year-on-year basis over the past 25 years, and they all came during times of slowdown or recession around the world. Renishaw's relatively rare profit stumbles came in 1997 with the Asian debt crisis, 2002, the bursting of the tech bubble in the US recession, 2007-9, the Great Financial Crisis, 2013-16, European debt crisis and stagnating global growth, and then 2019 and 20, when the world slowed and COVID hit. The profit outlook for 2023, if one is given, will therefore be particularly important, although Renishaw is well equipped to withstand any downturn that comes its way, as it's got a net cash balance sheet. That, alongside free cash flow, funds the dividend, and for the year to June 2022, Renishaw is expected to declare a total dividend of 76 pence per share, compared to 66 pence a share last year. More strategically, Renishaw did actually put itself up for sale in spring 2021, but it called off the process that summer when no satisfactory offers were received. Well, the shares have slumped since then, so I would guess it's unlikely that management will revive the plan, but we'll see. I hope that you and your families are all in good health and good spirits. Thanks ever so much for watching, and I look forward to seeing you next time.